Every real estate crash looks different until you zoom in on the moment right before it happens. Prices surge, and then, boom, demand vanishes. But ask yourself, why do buyers disappear overnight? Why do mortgage delinquencies quietly rise while headlines scream hot market? And why does it always feel safest right before the fall? If you're seeing these signs now, you're not paranoid. You're early, and that it could save you a fortune. This is what always happens right before a real estate crash. Okay, so let's jump right in and talk about the three things that always affect housing prices. And while this might seem like it's an oversimplified explanation, believe me, these are the three things that you need to pay attention to. The first is interest rates, the second is wages, and the third is consumer confidence. And these three things largely dictate supply and demand. Now, there's other things that play in, things like domestic migration, but for the most part, these are the three primary things that will affect everything else. And to put this in perspective, low rates, well, they increase demand and they decrease supply. The lower the rates, the more people want to buy, the more comfortable people feel buying, and ultimately, the less supply there is because there's so many buyers. People want to hold on to their properties, people start investing, and subsequently there becomes less available on the market to buy. And of course, the inverse is true for all of these as well. If rates go up, demand decreases, supply increases because everyone's worried that they aren't going to be able to cash out their property, and so on and so forth. Then there's falling wages. This increases supply. As people are no longer able to afford their properties, they start to come onto the market. And at the same time, when wages are falling, it's usually because there's something bad happening in the economy and people get scared, which decreases demand. And then last but not least, there's consumer confidence. This is usually the thing that shifts last, but everything adjusts accordingly and it adjusts quickly, just like it did in 2008 and during the early pandemic and throughout the pandemic as prices went through the roof. But the pandemic's actually a really good example because we saw ultimate fear where people were putting their houses on the market. They wanted out because they were afraid that they weren't going to have wages, only to find out that there was an unlimited money printing machine and that they were actually going to have a stable income combined with lower interest rates because interest rates went down to prop up the economy. And that led many people to not only jump into the market or buy bigger properties, but also to invest in properties, which meant there was less supply because there was so much demand that those properties were getting scooped up and turned into things like rentals and Airbnbs. And if we look throughout history, you can see that it's always these three things. In the 1980s, there was inflation and the Volcker rate hikes. Inflation surged, the Fed had to raise interest rates above 17%, and mortgage rates subsequently became unaffordable. So housing starts and housing values dropped significantly. It led to a crash. Then, just a short time later, there was the savings and loan crisis of the 1980s and the 1990s. Financial deregulation led to risky lending. People were buying properties that they couldn't afford. Savings and loans institutions started collapsing, and the credit crunch, which was caused by there not being enough wages to afford the houses that people were buying, contributed to the 1990 and 1991 recession. Then there was the 2008 subprime mortgage crisis, where there was widespread risky lending. Everyone believed that prices could only go up. And when the bubble burst, defaults led to not only a recession in the US, but a global financial crisis, causing home prices to fall 20% or more in many markets. And not only that, there was a massive amount of people who lost their homes. And then last but not least, there was the pandemic boom and the subsequent correction, where low interest rates led to high demand, and that fueled a surge in home prices. But those prices peaked in 2022 and then declined as interest rates went up and cooled the market. That led some markets to see 20% plus declines in home prices. And it was really simple. Interest rates went down, people got excited and bought homes. Then they started going up, people got scared, started selling homes, and stopped buying. And it's the same pattern that repeats over and over again. The only difference is what caused the major change in consumer confidence. And most of the time, there were indicators that foreshadowed what was about to come long before it actually happened. So let's take a look at indicators that foreshadow a crash. Now, one of the most often cited indicators of properties being overvalued is the price to income or price to rent ratios. When the values of properties typically go above 5 times what incomes are, people think that properties are largely overvalued. And many will point to this ratio to signal that there's a disconnect from fundamentals. They'll also suggest that these high ratios often precede corrections. But you have to be really careful with this indicator because it's not actually a really accurate indicator. What's more accurate is mortgage debt service payments. Because what happens is when interest rates go down substantially, the monthly costs associated with owning a home also go down. And this creates bandwidth for housing prices to increase. There's a general rule of thumb. It's called the 1% 10% rule. For every 1% reduction in interest rates, there's an increase in affordability of about 10%, which subsequently means that there's a 10% tailwind with respect to housing prices. Because if everyone can afford 10% more with respect to the price of a property, because interest rates went down, which allowed borrowers to borrow more money, well, that's going to increase the potential value of properties. And you can go back in history, and this rule almost always holds true. And the reason why is because it's just simple math. And if you look at this chart, which is the home price index versus debt service ratios, what you can clearly see, it's mortgage debt service ratios going up substantially that actually leads to price corrections. And there are times, like right now, where home prices from a price to income ratio have gone up significantly, but the debt servicing ratios are still at historical norms. And this again is because price to income ratio isn't a really good measure of whether homes are overvalued. How much people are paying for homes out of their monthly income, that is a significantly better indicator. Now, the next indicator that could indicate a crash is coming is when there's rapid price growth. When prices are rising faster than wages, this signals unsustainability, especially when interest rates are flat. And double-digit annual growth in real estate values are often unsustainable, especially if interest rates haven't gone down substantially. And this leads to an affordability crisis. And as you can see from this chart, home prices are actually a lagging indicator of real household incomes. And real household incomes are incomes when adjusted for inflation. So when the amount of money that you have relative to the cost of living is going down, this typically is an indicator that somewhere down the road, housing prices could go down as well. You can see it clearly here in 2007, and then you can see it again in 2019, 2020, 2021, with values coming down 1 to 2 years later. Then there is lending standards. This, by the way, in my opinion, is the single biggest indicator of a crash that's about to come. When credit risk starts to go up, that means that money is being lent to people that cannot afford to repay it, which is ultimately going to lead to catastrophe, both for the individuals that the money was lent to who couldn't afford it, and potentially for the greater market as a whole. And these risky lending patterns include things like an increase in subprime loans or low down payment loans. They also include things like risky products like ninja loans, no income, no jobs, no assets, and ARMs, adjustable rate mortgages, where the payments and the interest rate resets 2 to 3 years later, causing payments to go up and leading to personal financial ruin. This, by the way, is exactly what happened in 2008 and pretty much every housing crash before it. It was almost always the risky lending due to more money being available to lend that caused the housing market to reset. And the data here is clear. It is very rarely the interest rates that cause the crashes. It is when mortgage debt service payments become too high because of risky lending that causes mortgage delinquency rates to go up, which ultimately causes pretty much every crash. It's the inability to have the income to pay the mortgage that you got that leads to personal financial crises, and when done en masse, leads to national real estate crises and potentially global ones, like in 2008. And in almost every case, you can see this coming, especially when it comes to monetary policy. If there's going to be significant reductions in interest rates, we're probably going to see a run up in prices a few years later. But then when the tables turn and interest rates go up, this is going to reduce affordability and it's going to lead in all likelihood to a correction, especially if it's not done slowly. And the evidence here is clear. It was the trigger for past crashes like the 1980s and 2008, and it's also the reason we saw such a big correction after the pandemic. And this is really the graph that says it all. When you start to see interest rates come down, as you did after the financial crisis, you start to see a period where housing prices are going to go up. And ultimately, when interest rates turn and they start to go up, well, that too will inevitably cause a correction in prices. So a graph like this, where you see interest rates that have gone up over the last several years, will typically be followed by a graph where prices come down. Now, that doesn't mean there's going to be a crash, but it almost certainly means there's going to be a correction. And by the way, the national housing market is not one housing market. It will be different for every single housing market across North America, depending on the demographics, domestic migration, and what's going on in each individual city. That's why places like Texas, when there's a recession, perform better than the rest of the country. And by the way, in the same way, when there is an oil price crash, Texas suffers and other parts of the country do well. This is also what causes a lot of domestic migration. When things get way too expensive in California, people look for greener pastures. Companies look for greener pastures. And that is the real tale of the real estate market. People will always gravitate to places that have better economic circumstances, the prospects of higher wages, or lower costs of living. And then, last but not least, there's always inventory. Now, one might suggest that inventory plays an important role in housing prices as well. But inventory, again, is a lagging indicator. It's a lagging indicator of demand that ultimately comes from consumer confidence and interest rates. Because quite often, homes that get built are built based on the economics of a year or two prior, not when they actually become occupied. So if there's rapid building in a real estate market, and then all of a sudden the economy in that same market turns, that market could find itself with an imbalance of supply and demand because the economics of building were based on what was going on before in the economy, not what's going on right now. And in contrast to that, unfavorable building conditions because of a downturn in the economy could see there not be enough properties available for sale when the market does get better. But in many cases, the building that was deemed necessary when times are good is completely unnecessary when times get bad. And this leads to rising unsold inventory, which weakens seller leverage and leads to lower prices. And again, you can see this clearly in the charts. When home sales are really high, home prices tend to go up. And when they start to fall, well, the home price index no longer goes up on a steady upward path, it starts to waver. And eventually, if things don't turn around in the economy, it could turn the other direction. So the question is, how do you prepare for the inevitable crash or the inevitable correction? Well, it's really simple. Always buy within your means. Avoid stretching your finances. Even though if it feels like you can afford it right now, always give yourself some breathing room. And definitely avoid speculative buying. The worst time to buy investment real estate is when everybody else is doing it. The best time is actually when prices are coming down, but that's also when everyone's too scared to do it, so nobody does it. Then you want to make sure that you focus on affordability and personal needs. Do you really need that McMansion? Or can you live with something smaller that, by the way, is probably not going to be as hard to clean because it's not as big, but that is significantly more affordable and won't find you in a financial crisis when the economy does turn? So this is really simple. Buy properties that will still be safe during downturns, and do that by buying properties that are affordable. And if you can't afford the home that you think that you need, don't push yourself to buy it. That's usually a pretty good sign that prices are going to turn at some point. Just wait for them to come down, like many people did in 2023 and 2024, and you'll be significantly happier that you did. Then it goes without saying, and this is for the American audience, not necessarily the Canadian audience, which, by the way, 5-year fixed mortgages in Canada are essentially adjustable rate mortgages. But the US has the unique ability for mortgage borrowers to borrow with 30-year fixed loans. And this protects you from rising interest rates, in contrast to those adjustable rate mortgages that could see your interest rate go up significantly and cause you significant financial pain. So having stable monthly payments that you know that you can afford for the long term ensure that if the economy does get bad, you're not going to lose your home. So it's important to avoid all of these exotic loans. Keep it simple, fixed rate mortgages, and make sure that you're buying something that you can absolutely afford, even if your income falls by 15 or 20%. And not only is it important to only buy a home that's affordable in the long term, but to also build financial resilience. Now, if you have 100,000 or 200 or 300 or 500 or a million in investments, you probably don't need to worry about an emergency fund. What you actually need to worry about is making sure that you protect your money so that you don't lose it. But if you don't have any cash on hand and you own a home, you need to be doing everything you can in order to get a 3 to 6 month emergency fund. In addition to that, whether you own a home or not, you should reduce high interest debt. If you have credit card debt, that should be your single biggest financial priority. And that will help you build and keep strong credit, which ultimately allows you to get better loan terms when you do go to buy that property, or if you need to go and refinance. But most importantly, and this is something that I think is lost on people, is you need to make sure you diversify your assets. Avoid having all of your net worth in real estate. Make sure you're balanced. You have stocks, bonds, cash. Don't just go and take every penny that you have and dump it into a house. Keep some in other types of assets so that if the real estate market crashes, you've got other investments that maybe aren't suffering as bad or are perhaps growing. And at the end of the day, we should always be hoping for the best, but definitely planning for the worst. And if you do so and things go well, you have nothing to worry about. But if things get bad, having a plan for the downturn, having a plan B is what will prevent you from losing your home and suffering. And I can't emphasize this enough. You need to be conservative with your future price assumptions, both from the perspective of how much income you're going to be earning in the future and from the perspective of where housing prices and interest rates and everything else will go. People make the mistake of creating a financial plan based on their expectations that things are going to get better, and they don't always do. Sometimes things get worse. So you need to be conservative with your financial projections when you're looking to buy a home, or for that matter, if you own one right now and it feels like you can't afford it. Because the next depression, the next recession might be right around the corner. And by the way, if you want to see what always happens right before a depression, make sure you check out this video right here. A lot of it is pretty similar to what happens before a housing market crash.